You have seen the headlines.
Trip into a recession.
Is already in a recession.
Index predicted a recession.
Fall into recession.
If a recession starts tomorrow, would you be ready? Struggling to keep up? Welcome to the FOMO Fix. In today's session, we're going to break down exactly what you should do even if the markets crash overnight. Welcome back to the FOMO Fix. I'm Hazelle from the Joyful Investors, your navigator on this journey to financial empowerment. And joining me today, we've invited Billy To and Louis Lim.
Right, I'm Billy To. I'm the SGX Academy trainer, as well as I'm also a head of regional retail research at CGS International. I've been in the investment industry for more than 10 years, so I've been covering countries like Thailand, Philippines, Malaysia, as well as Singapore. So I look at various markets, and so I personally am very interested to talk about investing to retail investors, because I think the future of investing belongs to retail investors.
Hi guys, I'm Luis. I'm currently studying mechanical engineering at NUS. I'm currently 21 years old, and I've been started investing since 2023. It's been a great journey so far and super excited to be here today.
Wow, great to know that. Okay, before we begin, let's do a quick check. On a scale of 1 to 10, with 1 being least and 10 being most, how worried are you guys about a potential recession now?
I think at around 7 to 8.
7 to 8, and for Louis?
I think around 5 with the recent tariff thing.
5, so in the middle.
Yeah.
Okay. So actually before this, we also ran a quick poll on YouTube for the public to take their votes. So let's take a quick look at the results. So most people are actually watching out for a recession. They're a little bit concerned, about 36% of them. And quite a few, about 28%, are still figuring out what a recession even is. So that's why we're doing this episode. So maybe Billy can begin off by helping us to clear up this part. What exactly is a recession?
Okay, I think recession is essentially a decline in economic activities at a significant level over a period of time, right? Simply put it, buyers are spending less, and then of course companies make less money, which then leads to freezing in hiring or even layoff of employees, right? So it's also harder for you to find jobs then, right? So what that means is that unemployment rate is higher, so then people will then spend even lesser. They are cautious about spending because of that job security level, right? So then this becomes a domino effect, which leads to a sharp decline in the economic activities. Yeah. But of course, there are various different triggers for recession. So I guess if you look at the most recent one, is probably COVID-19 back in 2020. So that's a sudden stop in economic activities because you can't travel, right? Then you can't go out, you can't go to office, shops are closed, factories are not open, right? Except for the essential goods and stuff like that. So that's a sudden stop to an economic activity. So that's a drastic drop in economic activities, which is a very sharp recession. But it was also a very short one because the government steps in. So basically, I think in Singapore, the government also give vouchers, monies to support whether it's businesses or household. Similar to Malaysia, Indonesia, Thailand, I think across the world, US. So a lot of monies are spent to sort of boost the economic activities. But during that time, I think it was in April or May, I can't remember, but US lost about 20 million jobs alone. So it's in just a month. So that's a sharp, drastic drop, right? Then, of course, it was also the first time that oil prices fall to a negative level in its history. So that's what you will see in recession. But not all recessions are going to be so drastic. I think I'll just bring you another example before we move on, right? So a more recent one would probably be the global financial crisis in US. I think that's a long period of recession. I think it lasts about 18 to 24 months. So that's a long period of time. So what happens was that it was triggered by defaults in mortgage. So back then there was the subprime crisis, right? So because it gradually leads to the subprime crisis, which then when Lehman Brothers announced bankruptcy, that's when the whole thing tanked. So basically, in a recession, you will see asset prices came down, whether it's stock, whether it's property. So you see these sort of things happening because people are not spending money. So in short, money is not moving. Everyone is just tightening their belt. Yeah.
I think you brought up a good point, right? That not all recessions are the same. So we have the one in 2020 that was in fact the shortest in history on record for recession. It's about just 60 days. And then the 2008 that you talk about, right, it was the longest in history, spanning over more than 500 over days. Yeah, so clearly not all of them are the same. And in fact, an interesting fact about recession is that generally the stock markets, right, starts to recover even before the end of a recession. Yeah, and not just that, the average S&P 500 return in the 1 year period following the recession, on average is up by about 16%. So I guess for investors, that's something that they will probably want to know about and see how they can actually position their portfolio
Yeah.
on that aspect.
Taking crisis as an opportunity.
Right, yes. Louis, earlier on you said you pick a scale of 5, right? Rating
Yeah.
of 5. So what made you choose 5?
Because I think, to be honest, I'm not very worried about a recession because I see it as an opportunity for me to add in stocks of great companies rather than a crisis. So I think if we are focusing on investing stocks of great companies, what I mean by great companies are like those companies with strong economic mode and resilient cash flow and also strong fundamentals, then if we view it from a long-term perspective, the market will actually rise back in a long term,
Yeah.
and we don't actually need to worry about it.
So over the long term, their share price will always go up on
Yeah.
the uptrend. Lah. So if you take advantage of that crash, you can buy at a cheaper price.
Yeah, buy the dip.
Yeah, and that's in fact one of the greatest way to grow your wealth, right? Accelerate that wealth building journey.
Yeah.
So maybe enough about explaining what a recession is all about. Let's play a game that we have prepared. So it's called Draft Pick, right? So how it works is that each of us are going to take turn and talk about one worst investing or money mistake that you think anyone could make during a recession. It doesn't have to be investing, it could also be money, personal finance in general. So, and once that mistake is being mentioned, we cannot repeat again. Okay? So maybe we start with Billy.
I think probably one of the ones that I made personally was when when share price came down drastically, and then you get into a panic mode and you decided to sell off some of the stocks, right? So I think that's probably one of it.
Why is that a mistake? And also, instead of doing that, what should we do then?
I guess the whole idea is you need to look at your investing plan. Like, for example, why did you invest in a certain asset class or companies or stocks, right? So I think that's very important for us to keep in mind whether that fundamental has changed. So it's not that you need to hold on to stocks all the time. I'll just give an example that when you should sell. So I think Kodak, I'm not sure how many people know that it was a very big company back in the past, right? But I think it becomes more or less worthless because they cannot capture when digital camera comes into play. They fail to evolve. So I think when that fundamental change, then that's probably when you want to look at whether you want to sell. But try not to sell as stocks that if fundamentally there's nothing that's changed aside from the big headline news. I think there's no reason to panic on that front. Yeah.
Okay, how about Louis?
For me, one mistake that I made is that I didn't left aside a lot of cash. So last year, that a market correction happened. So that time I cannot do anything because I have
Don't
no
have
cash
cash.
to continue invest in. Yeah, so now I've learned the mistake. I will set aside around 15 to 20% of my cash. So if there is another market correction happen or the stock market drop, then I can use this money to continue into more stocks of great companies.
Okay, yeah, I think these two mistakes that you guys mentioned are very good ones, right? So maybe something different from you guys is, so we know that during a recession, we need to buy, right? But I guess one mistake is they just blindly buy. So even if it's not a really fundamentally sound company or high quality business, they kind of take advantage of the cheap price and buy, but actually it's not really a good business. So eventually those kind of businesses, they're not going to survive. There's a higher probability that they're not going to survive through any recession or any crisis, right? So while we say we want to buy the dip, but it's also not about blindly buying any dip, right? You also have to make sure it is the right companies. So if you bought the wrong companies, you can lose even a greater amount of money. So for me, that's one possible investing mistake.
Yeah. Can I just add something on that?
Sure.
So I think a lot of investors now have not experienced that because we have not seen a prolonged period of bear market for a long period of time. So a lot of us have been so used to buying the dip and then recover from that. Just for example, in the 2000 to 2001 recession period, I think that was the tech bubble burst, right? A lot of us heard about that. But what people don't realize is that there are hundreds of companies that actually went bankrupt.
Exactly. Yeah.
So it's really not about just buying the dip. It's about looking at the fundamentals of it. Yeah.
Yes. So we talk about all this, some common mistakes that people may make when it comes to investing, right, during a recession. So I guess, I mean, if you have made any of those, the most important thing is we learn from it so that we don't waste the cost that's incurred through those mistakes, right? So moving forward, for Louis yourself, how do you personally help yourself to prepare for recession?
I've saved up some savings as emergency fund. So if a recession really happens tomorrow, I won't feel pressure to sell out my stocks in panic. And
Okay.
for now, I've learned my mistake last year, and I've set aside some cash. So if the market drop, right, I can buy the dip and continue to add in stocks of great companies. And if the stock market continue to drop, I might actually do a strategy called cover call to protect my downside risk and also reduces my losses.
So for young investors, right, who are looking to protect themselves during a recession, right, what are 3 actions that any young investor can look at to be more recession ready, even if right now they're just managing a small portfolio, right, for the young investors or young students? What can they do?
I think, well, whether it's recession or not, I think these 3 strategies probably work. I think it's what Luis mentioned. The first thing is really build up your emergency fund, right? If you don't have any now, just start with whether it's $200, $500, just build that up. So I recommend probably between 3 to 6 months of your basic needs. So then, like what Luis mentioned, then you will not be pressured to sell your stocks in the event that there's a crash or if there's a recession or if you lose your job or anything, right? Then you'll be able to survive through this period of time. So it allows you to have that mental space to pursue what you want in your investment goals. So that's very important. I think secondly is really stay invested, but be selective. I think it's very important. A lot of people stop investing in a recession period because there are a lot of bad news, a lot of panic, a lot of uncertainties. So the idea is really to just make it a habit to invest on a regular basis. I would personally recommend 6 months, right? Because it helps you to avoid buying, trying to time the market or being pressured into looking at when's the best time to buy. So I think that will work. And looking at my personal advice would be start building it with your consumer staples because that helps you to build out a certain portfolio. Staples means things that you need to like think of, things like food, toiletries, things that will continue to use even though if it's a recession, right? So that's the second one. And I think the third one, although it's the third one, I think it's probably the most important one, is really invest in yourself. I think there's a general term that Gen Z like to use, like hustle and stuff like that. And I think hustle sounds like a bad word. I think it's looking beyond your 9 to 5 and try to build something meaningful out of it, right? Whether it is building your own skill in video editing, whether it is in Excel. I know it sounds boring, but I've been in the finance industry for more than 10 years, but I've still seen a lot of people that doesn't know simple coding to automate some of the Excel processes and all that. So differentiate yourself so then you stand, above others when it comes to, in a recession, probably the most important thing is building your income, finding jobs and stuff like that. So I think that's very important. And if you repeat that cycle 1, 2, 3, and then probably if the first one, you don't have to keep doing it. But if you make it a habit and keep repeating that cycle, then I think it's a good way for you to build up a resilient.
I guess these days, you can also learn how to use AI tools, right?
Yes.
To be more efficient. That's a new skill
So it's
set.
very important to learn that. Find something that is meaningful to you and work towards that, because then it won't feel so burdensome, because otherwise you'll probably be very tired because you work 9 to 5 and then you still continue to work after that, right? Find something that you have passion and meaning in. Yeah. I mean, that's personally what I would advise.
Right. So you actually mentioned about continue to invest, right? And I think you mentioned a good point, looking at consumer staples. On that note, maybe you can help us to expand a little bit more. Any other types of companies, sectors or industries that you think generally could hold up better during a downturn or a recession?
Okay, I think I'll start with sectors so that it's easier, then I'll dive into a bit of some of the companies.
Sure.
So I think sector, like I mentioned, consumer staple is the first one that we will want to focus on, because whether it's downturn or not, you still need to eat and you still need to use all your normal toiletries, your basic needs, right? Another thing is healthcare. I think it's very important because if you're sick, even if it is a downturn, you still need to go for treatment. So it's not an option per se, right? I think the third one is probably utilities. Your lights, your water bills, all these companies that provide all this stuff are important because firstly, they are usually companies that have their cash flow is usually very predictable because of the
stable,
the business that they're in, and they also usually give a certain dividend which is at a very decent level. So that's another one to go for. I think discount retailers are also important because in a downturn, people tend to spend less. So instead of eating out, they'll probably buy from groceries and eat in home, right? So that's another one. But I'm going to add one more that's probably a bit less common, which is I think solid tech companies are important in today's era. I think we are living in a very different age compared to what we were 10, 20 years ago. So tech is become very part of our daily lives. I'll just give an example. Microsoft as an example. I think, I'm not sure how many of you remember there was an outage because of some virus attack.
Okay.
So it actually affects a lot of industry, airlines, and a lot. It just
Yes.
shows how much tech has become part of our lives. So that's a big need on it. So whether it is a downturn or not, these businesses are likely to continue to do decent, right? So in terms of companies, like I think, for example, staples, I think in Singapore, you can look at things like Singsale. It's also go with discount retailers. So I think it's very solid. This kind of business, whether it's good time, bad times, it's good to build that up. So if I were to start off my portfolio, this is one of the few companies that I'll start looking at. Food Empire is also good, but it's not just in Singapore. It's probably more regional based. So they sell a lot of coffee stuff. So it's things that people will still buy,
Okay.
right? Probably you won't buy outside anymore. You probably buy the coffee to make it at home, right? So those are things that I will probably go for. If you're looking at global market, then probably things like Coca-Cola, PepsiCo, P&G. I think this will give you a bit more resilience in
Yes.
terms of that. Healthcare-wise, you can look at Raffles Medical, IHH Healthcare, Parkway Life. So there are actually a lot of options. So in short, what you can look at are companies that are likely to continue to deliver and add values to the lives of people, even in a downturn. And these are companies that will continue to do that. So I will avoid things like discretionary, your gunting and stuff like that. So those are probably things that I will avoid.
Okay. In other words, products and services that in our everyday lives
Yeah.
that people must use whether there's recession, inflation, or whether the economy is booming.
Yeah.
Right. Okay. How about for Louis? Have you considered any of those companies that Billy have mentioned, or any other things that you want to share also?
Yeah, I've looked into this when managing my own portfolio.
Mm.
So generally, like what I said just now, I tend to invest in companies that has strong fundamentals like low debt, resilient cash flow, and also strong economy mode like high pricing power. And to be specific, I understand that different sectors will have different performance during different tough times. So
Yeah.
for example, right, during a deep recession, I tend to avoid companies that is sensitive to the economy and its valuation is relying heavily on its current earning. I will avoid sectors like banking, industrials, materials, and also consumer discretionary. So after a deep recession happened, I will slowly started to change my portfolio strategy into a more attacking kind. I will slowly look more into tech stocks because tech stocks valuation is based more on its future earnings rather than its current performance.
Yes.
So if there is any bullish factor that will cause a potential bounce back, for example, such as the Fed started thinking to cut interest rate, then tech stocks will be the most benefited. For a mild recession, then it will be quite different because it will be more tricky for us and it will be harder for us to strategize and also plan for our portfolio allocation ahead. So in this situation, I will choose a more balanced approach for my portfolio. So I think healthcare sector is a good choice for this kind of situation because it's both defensive and also it has the long-term growth potential. For example, the healthcare sectors has beaten the S&P 500 over the long term. So I think it's a great choice for this. And healthcare companies normally have higher pricing power and people also need healthcare services during recession and no matter how hard is the economy.
Yeah, right. Then I guess, for example, you talk about healthcare, right? So within healthcare, there's also different types of healthcare, right? Then certain types
Yep.
of healthcare companies might be even more resilient than others as well. So these are the things that investors can think about to help them prepare for their portfolio and how they can invest during a recession. Yeah. So no, not just that, when we talk about recession, right? I guess there's a lot of questions that people have, and one of it that a lot of people ask online that we see is this: is having cash good in a recession? So Billy, what's your take on this?
I think having cash, whether it's recession or not, is good. I think there's a caveat to it.
Okay.
I think having cash is good for two things. One is that it gives you the protection. You don't have to sell off your assets because, for example, if you lose a job, you still need to pay your mortgage and stuff. So you don't have to sell your investment just because you don't have a job for a couple of months. So cash is important on that front. Secondly, I think what Luis mentioned earlier, it allows you the opportunity to buy at a bargain, right? So I think it's important. But there is a caveat to it, meaning that if you're holding too much cash and waiting for a recession, then it's a wrong move because you never know when recession is going to happen. So Luis mentioned just now about things like mild recession or sharp recession and stuff. But the question is, how do you know when is a mild recession or when is a sharp recession? Most of the time, by the time you know it, it's probably a bit too late, right? So it's a bit difficult to gauge when is it going to be a recession. So to keep your cash just hoping for a recession in order for it to buy at a bargain is a move that will, you'll probably lose out a lot because recessions only happen like for the last 50 years, I think maybe 7 times or to 8 times if you include the Asian financial crisis. So it really, that's really the caveat. So I think the emergency fund that I talk about, I think that makes a lot of sense because 3 to 6 months of it, that allows you to invest if you see a correction, a sharp downturn, you can use those money to invest in. But of course, it's different for every individual.
Yeah. If I could sum up, it's more like, when you talk about investing, it's actually a nuanced approach. So there is no right, like the exact only one way to invest. So there are many different investing styles and methods. So when I speak to retail investors on the ground, I find that there's a group of them who likes to do DCA, dollar cost averaging. So then for this group of people, maybe every month they put in a fixed amount of money to invest. So then for them during a recession, probably they will not have more cash to go and deploy.
Yeah.
So in any method, there's a trade-off. So for this group of people, then the trade-off is in this aspect. Then on the other hand, there's also another group of people who wants to be more strategic with the price that they buy their investments at, their stocks at, right? So then for this group of people, yes, during recession, maybe they might have more cash to deploy during a recession. But again, there will also be a trade-off, which is that sometimes the price continues to go up and you don't get the chance to buy. So in any investing method, I guess that there will be the trade-off. And that's where investors have to go and find the right approach that is suitable for them. Like for myself, I am actually the second one. So I follow a more strategic approach. Like what price that I buy at. But, I don't think there's any right or wrong. But you have to follow through that same method consistently to see results. If you sometimes do this, sometimes do that, right, then in the end, you will be nowhere. Yeah. So that's how we can actually think about it for this. How about for Louise? Do you have any burning questions or things that you want to discuss for today's topic of recession?
Okay, so right, Mr. Billy, I think one hardest thing for many youngsters like us is that when we saw our portfolio drop more than 20 to 30% during a market correction, especially when we are surrounded by a lot of noises around us, such as on the platform like YouTube and TikTok. Then my question is, how can we build the emotional discipline to avoid panic selling during any market correction or recession?
I think, like I said earlier, it depends on why you invest in the company, and I think you need to know that reason. And if there's a change in the fundamentals of the company, for example, if there's a change in leadership, right, then you might want to consider. So I'll give an example, right? When Bill Gates stepped down, right, it replaced by Steve Ballmer. I really don't like the CEO at that time. Earnings were still growing very strongly for Microsoft, but I don't like the way that the business, the CEO was driving the company. So it just doesn't fit right to my investing style. So I decided no, right? But when Nadella came in, it's a direction that I like. So I began to invest more in Microsoft. So I think you must know why you want to invest in, right? So when you know the why, then it's easy to ignore the noises, because then at the end of the day, it's always comparing with all the noises with the reasons that you have decided to invest in, right?
Yeah.
Yeah, and I guess if you really have a right investment approach and framework, then you will be able to discern what you see online, like what are more of noises and what are concrete stuff that you could take a look at, right? So, but for a lot of investors, retail investors, they don't have such skills, they don't have such knowledge. So they will only just blindly follow what they see on YouTube, on TikTok. And that's how they can get into trouble very easily, right? And maybe try to immerse yourself with people who are on the same, I would say, like-minded investors who have the same style of investing. I guess that will also help. But if you realize you're always with people who are always panicking during crash, then during price rally, they're always very greedy, then it's very you'll be very easily influenced by such people as well. So I guess, having the right community of like-minded investors that you speak with, I think that also helps over the long term as well. Yeah. Any other questions that you have, Louis?
Mr. Billy, can I ask, how do you allocate your portfolio? Like just now you mentioned about healthcare, tech stocks, and so consumer staple. How do you allocate your fund into these sectors?
So
Their percentage.
So the way I see it is, of course, I don't just look at one country. So I look at regional. So firstly is I start off with, I always tell people to start off with your local market because you're more familiar with your local market. So I'm a bit surprised when you told me you start off with US market, but it's fine, right? So I usually do that, right? What I do is that I always decide it by safety and risky portfolio for myself. Basically, I will put in about, because I'm still quite young, so I put in about 40% on risky, right? Another 30% on safety, and then another 30% on other assets. So that's how I play it, right? When it comes to safety, then I look at things like I talk about, like your staples, your healthcare, and all that. So I don't really specifically look at percentage on which sector in terms of allocation on that front. I look more into names that I'm more interested in. So very much like you, when it comes to staples and all that, I look at a lot of companies with low borrowings, very consistent cash flow, strong balance sheet, and so those are things that I really look at when it comes to the safety part. Risky, I'll look at companies that have growth potential. So risky in what way? Not things that crypto, for example, I don't touch into it because I don't understand it.
Yeah.
Right. It's not that there is no meaning in it. It's just I don't understand how it works. Right.
Yeah,
I don't know how it's going to add value to it. So I look at things that can probably add value. So one risky example that I can bring up is probably Tesla. It's very expensive. It is very expensive.
Yeah.
Valuation wise, it's very high, but it does add values in the sense that if the autonomous vehicle services that they're going to roll out, and of course the robotics that Elon Musk talk about, if it becomes a normal or common services that everyday people can use, is a game changer. So those are risks that I will look at, right? So AI is another thing that you look at, but again, not all AI. Look at what things that you understand with, because honestly, when people talk about artificial intelligence, there can be a lot of things.
Yeah.
Right? I honestly don't understand some of it, right? How it works and stuff like that. So I think it's important to invest in things that you understand and know about, right? So I mean, for me personally, of course, I know not a lot of people would have that time, but some retail investors don't have that time. So then probably you want to jump in things like ETF that offers you into growth sectors like tech. So that's probably an easier way to do it. So it depends. It really varies on for people. But because I'm in the industry, so I look at a lot more. So I have that benefit in a sense. Yeah.
Okay, so as we come to a close, right, maybe Billy can share with us one final piece of advice for young investors who are looking to prepare for recession.
So I think the takeaway from this is don't just think about surviving a recession. I think think about winning the recession. When I say think about winning, it means that take advantage of it, because a lot of young investors, you're young, right? If you're young, you have the time, you can have the patience, right? So take advantage of the crisis to build the wealth that you want to in investment classes or securities or companies that you believe in, that you have knowledge and understanding in. Take that opportunities, because you don't see this crisis coming all the time. And most people will sit at the sideline. And that's probably the biggest mistake that you will make in a crisis. So for example, I think we talk about the COVID crisis, it's just a 2 months, right? But how many people actually invested during that period of time, right? So it's really about taking opportunities. So don't just try to play safe all the time. I think it's a good opportunities to win the recessions for a lot of young investors. So take opportunities of that.
So when you need to attack, you have to attack. When you have to defend, you have to defend.
Can I add on that?
Sure.
One thing I realized throughout the years is that no one in the world can actually predict when a recession is going to start and end. Not even the top economists in the world. So if they can't do it, why should us also waste our time trying to predict the market? Yeah. So one quote that I want to share is that time in the market is more important than timing the market. So just stay consistent with our investment and stay invested in great company stock.
Right. So speaking of that, so Louis, for yourself, what is one thing that you are excited to do after today's session?
Yeah, I feel more prepared for a recession if it's going to come. And I'm actually looking forward for next recession, because like what Mr. Billy said, it's a chance for us to add in stocks and it's not a crisis.
Right, once in a lifetime opportunity.
Yeah, shopping day.
Yeah, shopping day. So big thanks to Billy and Louise for joining us in this discussion today.
Thank you for
So,
having us.
yes. So if a recession starts tomorrow, we don't panic, we plan. Whether you're right now trying to save up more or learning more about investing, or you have already started investing, you are on the right step in this financial journey. And this episode marks 1 year for the FOMO fix. So if you have learned even just one thing that's made you more confident with investing, that means a great deal for us. Until next time, keep a FOMO in check, stay informed, and happy investing. We'll catch you again in the next episode. Thank you.
Thanks.
If you're feeling fired up and ready to dive deeper, feel free to hit us up. Leave your comments below. We would love to hear your questions and topics that you would like us to cover in future episodes.